Yo, I'm Brendan. Today we've got to talk about some big changes coming to my dividend investing portfolio because I think I had some bad investments before. I found something else that I think is new and hot and interesting and worth investing in. And so I chopped out some stuff that I thought was not the best move and I added some things that I thought were the best move. So let's go over that today and I'll tell you exactly why and how and what I did. This isn't advice for you to follow. This is just documenting my dividend investing journey so you can follow along and see everything with total transparency. Let's go. I'll be the first one to admit that I'm not a dividend investing expert. Picking out exactly what you want to invest in and why is not only highly personal, it's also just pretty subjective because it depends on what you like and what you want to invest in. For me, when it came to developing this dividend investing portfolio, I'd pick some big names out there, some companies that you'd heard of like AT&T, Altria, Coca-Cola. And if I'm totally honest, I think part of that logic was like, hey, if it's big enough to have lasted this long, to be able to sustain a dividend for this long, then it must be a decent investment. Plus people like it, so let's just do it. Let's follow the herd. I also fell for what's called a dividend yield trap, where you just pick out something that has a really high dividend, but I've learned since then there's a lot of reasons not to do that, and that'll be a future video. But for now, I'll explain a little bit of that. The investment I'd chosen is called MPW, and I'd made videos about it in the past, but basically it's a real estate investment group. And one of the companies that they had in their portfolio was this hospital. For whatever reason, the hospital couldn't pay its rent, and that meant that MPW, which is the symbol for Medical Properties Trust that I had invested in, all of a sudden was in a world of hurt. Like basically a bunch of their income was now no longer available. The tricky thing about this is that because the way the stock market works, that made the dividend look more appealing. Whenever we do research and we look up what a dividend is going to be on a company, it just tells us their stock price and their most recent dividends, and they compare that number and they give us something like a 30-day dividend yield. And so naturally, by the way that math works, whenever the price of that dividend paying company goes down, if the dividend has stayed the same, then the dividend yield, the percentage of the money that we're expected to get paid, the percentage of our payout, the income that we're thinking we're going to make, naturally looks really, really high. I mean, look at this chart from the last 5 years with all the trouble that MPW has experienced. Their stock price has gone down and down and down. Even in just the last year, it's gone down 47.16%. That's wild. The mistake that I made here was not realizing enough about how dividends work and the problem that something like this can create. Because on face value, you could say, who cares if the price of the investment goes down as long as the dividend stays there? I'm here for the dividend, right? If we scroll down and we see the dividend yield on this thing, it says it's 21.5%. Oh my gosh. If I could get a 21.5% return, that would be awesome. I would take a 21% return all day long, every day, and the dividend makes that a little bit more fun. What's not to like? Well, there's another term that I've become more familiar with recently when it comes to dividends, and that's called payout ratio. A payout ratio is something that we need to pay more attention to whenever we're dividend investing potentially, because it could save us from getting into a lot of trouble. What it's showing isn't what it initially sounds like. I misinterpreted this and thought, oh, it's the payout ratio. It's like how much of the time they had been paying out this dividend. And so for a lot of the payout ratios, they're pretty low. Oh, it's like 25% or 50%. I thought that meant they were only paying out their dividend a quarter of the time. And so maybe you didn't get the dividend all the time. So maybe I need to find a higher payout ratio. I didn't actually think that. I didn't go out and seek a higher payout ratio. I just didn't bother to learn what it meant. What we actually want is a low payout ratio. And the reason for that is because that's the amount of the profit that the company made after taxes that it's able to pay to the shareholders. You and I, we're the shareholders. And so here's a little chart showing you what that math exactly is. Basically, it's giving you the dividend amount in terms of $1 or $2 or however much that cash payout will be to you in terms of dividends, divided by their income. If you're feeling lost in all these terms right now, don't worry, because I totally was for a long time too. What we need to know about this at the end of the day is this is the company's amount of extra money. It would be like if I said to you, what percentage of your paycheck can you afford to just blow? Not that these companies are blowing their paycheck on dividends. That's not what I'm inferring here. I'm just inferring that we're talking about a proportion of their net income that they can do something else with besides spend on their company. Because what they're doing is they're taking this income and they're paying out a portion of it in dividends to us. So they don't have that money to spend on running their own business. You know, this is like, for you and me, this is like our avocado toast money. How much money can we spend every month on avocado toast? Well, the kind of logic that we can apply to our own life applies to these companies. Let's say you're making $1 million per year and you still live with your parents in their basement. The amount of free money that you should have floating around that's available to spend on avocado toast would be absolutely massive. So in this example, if the avocado toast is the dividend and the net income is the amount of money that you have after you've paid your parents whatever it is, $500 in rent per year, you would have a tiny, tiny payout ratio. And that's what you actually want. I feel like this is a poorly named term. I wish I could change the name of this to something else. The avocado toast ratio, or maybe like the expendable income ratio, something like that that's a little bit more descriptive in terms of what we need to know. If I could design the perfect dividend investment for myself, I would want, a high yield. A high yield is great, but I would also want a really low payout ratio, because what that's telling me is that they have a ton of net income to pay for what is in reference to that income a pretty small amount. It'd be like, oh yeah, my avocado toast budget is 1% of my income. I can go get avocado toast whenever I want because it's such a small number relative to all the money that I have. That's what you'd want to see with a dividend payout ratio, is they can really easily pay this dividend. They have so much income right now, there's no way they're going to not pay this dividend. And in fact, they've got so much income, they can probably raise the dividend over time because the payout ratio is so small. Whenever you see a payout ratio that's 50%, 70%, 200%, then what that's telling us is, oh my gosh, they're having either a really hard time paying this dividend or they're just not going to be able to pay it at all. And so it's really tricky whenever we're dividend investing because we might get lost in these numbers. These numbers don't tell us the whole story. And I realize I'm using the numbers to justify trying to tell more of a story, but much like an onion or a very delicious cake, there's a lot of layers here. For me, I've got to decide where I sit in the world of dividend investing. Am I going to be a nerd and figure out what these kind of numbers mean? Or am I going to play it safe and pick one or two dividend paying ETFs and just bow out of the whole discussion? Because you can't really decide to be in the arena and play ball without knowing the rules of the game. How many different weird analogies can I use here? Onions, cake, playing ball. You're picking down what I'm putting up, right? Understanding that and realizing that I needed to basically pick a lane and stay in it meant that I needed to bow out of some of these investments that I'd made initially that weren't the best decision for me. I had picked Medical Properties Trust, and I had picked AT&T, and I had picked Tronox, largely based on either if they were popular or if they had a high dividend. That's not a great investing strategy. Thankfully for both of us, I'm not claiming you should invest the way I invest because I'm not a registered investment advisor. FINRA is going to come over here and slap me in the face if I tell you to do that kind of stuff, and so I will never do that. I'm going to show you the kind of moves that I make here, be transparent, and make this something that's more okay to talk about between people so that we can have an open conversation about it and hopefully learn together. So let me show you the moves that I actually made in my account. The actual position that I had in Medical Properties Trust wasn't super huge. It was only $90 worth, but I sold it all. I'm completely out of it. Then that very same day, I thought, you know what? I'm not investing in AT&T for right reasons either. So I got to get out of that. And I was in a lot heavier with AT&T, almost $930 worth. I got out of that. Then for whatever reason, I had picked Tronox. I don't know what this company is or does or why I even considered investing in them. I think I just wanted something else to invest in. So I sold my massive stake of $17.11 and I got out of that. Then what did I replace it with? Because I'm not just going to sit on the cash and do nothing. I had to reinvest that money. You may have seen a little preview of it already if you were watching the screen closely. I found something new. It's sort of like the cousin to something else I'm already investing in. This is an investment called JEPQ. It's the JP Morgan NASDAQ Equity Premium Income ETF. Just rolls off the tongue. For me personally, this is still kind of a crazy investment because it's not like I'm out picking my own individual stocks, but the way that this fund generates its income, it's a little scary. It's a little tricky. So the way that they do what they do is they use derivatives, which is fancy investing tools such as options, to create its portfolio. And so it's not just that they're picking companies who in and of themselves say, yes, we have extra income and we have decided to pay a dividend. And then they pick a bunch of those companies, slap them together in a big basket and say, we've created an income ETF. No, they're actually picking certain companies and then they're using these advanced financial tools such as options to create income in the portfolio. So it says here that they pick companies that are socially conscious, that they promote environmental responsibility, that the people who manage this fund employ fundamental analysis. All of this stuff is pretty vague. But we can see that the main goal of this thing is to create income, to create dividends. And the way they're going to do that is twofold. Number one, they're going to create this actively managed portfolio, and their benchmark is the NASDAQ 100 index. And number two, through equity-linked notes, specifically selling call options with exposure to said benchmark. And so even though on this top 10 holdings list, there are a lot of companies we've heard of, Microsoft, Apple, Nvidia, Tesla, Netflix. It's not just that they're investing in these companies, it's that there's a whole layer of risk on top of that they're using to create this, albeit massive dividend of almost 9% right now. It's also a little bit tricky because it has only been around for basically a year and a half, almost 2 years now. And so it doesn't have a long history of being able to sustain the strategy of dividend growth of anything like that. We can see here with the dividend payout history that it's been a consistent payer so far. I mean, it's got a really short little track record, but every month they've shelled out the dividend as planned. And then this chart shows us how much the actual dividend has varied over time from the very first one back here at the end of May in 2022, all the way up to the most recent one, which was just a week ago or so at the end of March 2024. So I've traded one kind of risky, badly informed investment for another risky investment that someone else now has to manage and someone else has to figure out how to do. If you want to dive a bunch deeper into different kind of options and derivatives and how you can create income off of that kind of stuff, The Plain Bagel made a really good video about that, and so you can watch that later if you want to. But for now, I'll show you exactly how much of this I bought. So the money that I sold from Medical Properties Trust went straight into this, $95. Plus everything that I sold out of AT&T went straight into this, and the little bit of money that I had from that Tronox sale also went into JEPQ. And so if we look into my actual Robinhood account right now, I can show you that the total market value that I have of this one individual ETF is just over $1,000. The total return has been almost non-existent so far, and it's really not meant to return all that much in the scheme of things compared to something like a growth stock. It's really meant to develop income. Because I've only been investing in it for a week or so now, I haven't had a chance to see any dividend come through or report back on that. But over time, as I continue to update the dividend investing series, then I'll let you know how this is working out. Or not. Maybe it won't work out. If you're curious what the services are that I use to actually invest, this dividend portfolio is hosted at Robinhood. And then the research that I was showing you here on my laptop is through Seeking Alpha. And I've got affiliate links for both of these services below the like button in case you're interested in starting. By all means, no pressure, but if you do, I get a little bit of a kickback. And if you start with Robinhood, I think you also get a little bit of a kickback. So there you go. I feel like sometimes investing is one of those tricky things where your results are almost like an inverse bell curve, where if you know nothing and you just invest in broad index funds, it seems like based on history, the results are pretty good. And then you get into that middle ground of I know a little bit and you just know enough to be dangerous and your results may be terrible. And then you can be at the whole other end of the spectrum, like a Warren Buffett or some hedge fund manager guy who knows tons and tons and then can leverage that to his benefit. But for those of us in the middle, it's just kind of tricky to know where you stand and where you want to stand. Ultimately, for most of us, I think what we should be doing is probably playing damage control. We don't need to sit here and wring our hands necessarily about every single little move that we're making in our investments. The bigger picture is probably more important. How can I spend less money and make more money? So I have a bigger chunk of capital left that then I can go and invest anyway. In the end, that's what should allow me to be the most free, I would think. Emotionally free, financially free, to have a low burn rate, to have a higher income, and to have a lot of flexibility there with the money that we have. Should we invest it? Should we go on a vacation? Should we buy something new for the kids? What do we want to do? Having those choices, I think, is what it means to live a rich life. So in the end, for me to be emotionally and mentally healthy, I'm not going to worry about this stuff all too much. I think it's fun to talk about and fun to track, but I don't need to lose any sleep over it either. Here's a video that the YouTube algorithm thinks is perfectly suited for you right now to watch today. And if you've already seen it or you're not subscribed yet, then click on my little round face right here and get subscribed so you don't miss a future video. And I'll see you guys tomorrow. Bye.